Welcome back, guys. So in this particular session, what we will be discussing about is cherry. Okay, so it's a SPR's question number 21. So what is it related about is that, so a background information is there. Let's read it out so that it'll be more clear. So Cherry is a large public limited company. It does not specify what kind of work it does. It prepares its financial statement using IFRS standards. Has a reporting date of 30th November 2006. Bonus is paid to directors each year, which is based upon the operating profit margin, okay, OPM. And then after that, exactly 1 year ago, right? Yep, exactly 1 year ago. On 1st December 2005, there was an amendment to Cherry's defined benefit scheme whereby the promised pension settlement was increased from 10% of the final salary to 15%, right? The directors believe that the pension scheme, which is in deficit, is not an integral part of the operating activities of Cherry. As such, they have changed their accounting policy so that from the current year, all gains and losses on the scheme are recognized in other comprehensive income. Okay, so it's in deficit, right? So they believe that this will make the financial statement more consistent, more understandable, and can be justified on the grounds of fair presentation. Believe that pension scheme which is in deficit is not an integral part of operating activities. Whoa. Right, anyway, remeasurement part is always in OCI anyway. So next is trademark. So first of all, let's what are we required to discuss the accounting and ethical implications of above situations. No actions. It does not talk about what the action could be for accountant, right? So professional marks will be awarded in this question for the application of ethical principles. Okay, we will do that. So first of all, let's talk about uh, pension scheme. So which is IAS 19, but what this says is that increased from this to this, right? Revised from 10% of final salary to 15%. The data is believe that pension is not an integral part of operating activities of Sherry. As such, they have changed their accounting policy, right? IAS 8. So when do we change accounting policy? Let's say that accounting policies, changes in accounting estimates and errors only permits change in accounting policy if the changes required by an IFRS standard or results in financial statement providing reliable and more relevant information. Okay, only in two conditions: when it is asked by the standard and when it provides more relevant and not faithful, it's more reliable and more relevant information. Okay, so what do we do? A retrospective adjustment is required unless change arising from a new accounting policy with transitional arrangements to account for the change, right? It is possible to depart from the requirement of IFRS and IAS standards only in the extremely rare case where compliance would be so misleading that it would conflict with the overall objectives of financial statement, right? Okay, so let's make these mistakes. So after that, let's talk about IAS 19 employee benefits. They believe it's not an integral part of thing, right? Employee benefits requires all gains and losses on a defined benefit seem to be recognized in profit or loss, except for the remeasurement component, which must be recognized in other comprehensive income, right? What does the question actually say regarding that? Is not an integral part of gains and losses on pension scheme are recognized in other comprehensive income. Okay. The amendment to the pension scheme is a past service cost and must be expensed, profit or loss. Additionally, it appears that the directors wish to manipulate other aspects of pension scheme such as current service cost. When the change has happened, that's why they have asked to change the accounting policy, right? Current service cost, and since the scheme is in deficit, the net finance cost. So first of all, they are trying to manipulate the service cost and then the finance cost as well, right? Since it is in deficit, the directors are deliberately manipulating the presentation of these items by recording them in OCI rather than in profit or loss, right? Deliberately, right? Next thing is regarding intangible asset or trademark. So let's talk about trademark as well. So on 1st December 20x2, that means exactly 4 years ago, 1st December 20x2, that means 30th November 20x3, 30th November 20x4, 30th November 20x5, 30th November 20x6, 4 years ago. Cherry acquired a trademark, Golfo, for a line of golf clothing for $3 million. Initially, because of difficulty in determining its useful life, Cherry decided to amortize the trademark over 10-year life. Using the straight line method, on 1st December 20x5, a competitor unexpectedly revealed a technological breakthrough which is expected to result in a product which, when launched in May 20x8, will significantly reduce the demand for Golfo product line. Cherry now intends to continue manufacturing Golfo products until 31st May 20x8. Amortization of $300,000 in relation to Golfo trademark has been charged for the year ended 30th November 20x6. So impairment, amortization of 300,000, right? Purchase for this amount. That means, so what did it do? 3 million divided by 10, right? So that's 300,000 per year, right? So we will need to, so it has basically just done the normal amortization on a straight line basis. Trademark is 38. Intangible assets. States that intangible assets with finite life so okay, so its useful life has decreased, right? Isn't it? So how many years until May 20x8, right? So that means until November 20x7, and then after that, so that means 5 years, and then after that how many months? November, December, January, February, March, April, May, 6. So 5.5, 5.5, okay. So that intangible asset with a finite useful life is amortized on a systematic basis over its life. The amortization method should reflect the pattern of benefits, and it should be reviewed at least annually. A change in amortization method is adjusted prospectively as a change in estimate, right? Not a change in policy, just a change in estimate under IAS 8 accounting policies. Changes in accounting estimate and errors, right? Expected future reductions in sales would be indicative of a higher rate of consumption. Future economic benefits embodied in an asset, right? Hence, the trademark should be amortized over the remaining. How many thing is remaining? So May 20x8, right? So we are reporting on 30th November 20x6, 30 November 20x7, and then 30 November 20x8 is. Okay, so the time frame is 2.5 years remaining, right? So we are reporting for including 30th November 20x thingy. So when did we come to know about this? On 1st December, right? Okay, so from this remaining 2.5 years period, which is 1st December 20x5 to 31st May 2008. Right. The date of estimate changes in the trademark had a carrying amount of it's basically $30 million divided by 10 into how many years have gone by? 1st December, right? 1st December 20x5 x2. That means 30th November 20x3, 30th November 20x4, 30th November 20x5, right? So 3 years. Or what we could do is into 7 out of 10, right? So this will be 10, 21 million. Is it 3 million? Okay, so it's 3 million. That means this should be 2.1 million. 2.1 million, right? The amortization charge in the current period should have been dollar. How much will it be? Basically, what was the remaining percentage? So carrying amount is 2.1 million, right? So into or divide by 2.5 years, right? So this will be 0.84 million, okay? 0.84 million, right? One more time, 2.1 divided by 2.5, 0.84, yep. This means that there is profits and intangible assets are currently overstated by how much? It's basically how much we should have been charging, 0.84 minus 0.3, right? Minus 0.3 was the charge that they had done, right? So 0.54 million, which is nothing else but 0.84 million minus dollar 0.3, right? The profit and intangible assets both have thingy, right? So accounting treatment, the correcting entry required is, what would be the correcting entry? 0.54, right? So debit amortization expenses around $0.54 million, and then credit intangible assets $0.54 million, right? So the reduction in life, right, could be an indication of impairment. So let's give them impairment of asset. This one, let's keep the explanation. Impairment of assets states that we should assess annually whether there is any impairment, whether there is any indication of impairment. Okay, indication that an asset has been impaired if any such indication exists, then the entity should estimate the recoverable amount of the asset. Thus, Cherry should test the trademark for impairment by comparing its carrying amount to its recoverable amount. Is higher of fair value is cost to sell and value in use. If the trademark is impaired, then the overstatement of profit and asset is much higher. quoted currently, right? So next thing is about sale and leaseback. So let's assess whether it is a actual sale or not. First of all, so Cherry sold a building for its fair value of 5 million to a finance company on 30 November 2006 when its carrying amount was 3.5 million. So at the end of the period, okay, the building was leased back from the finance company for a period of 5 years. The remaining useful life of the building was deemed to be 25 years. Okay. So they only leased back for 5 years. The remaining useful life of the building was deemed to be 25 years. So it can be concluded that the control of the building has transferred to the finance company. Okay. So lease rentals are 450 payable annually in arrears. The interest rate implicit in the lease is 7%. Present value of the annual lease payment is 1.8 million. Profit on disposal of 1.5 million in the SOPL. No other accounting entries has been posted, right? The directors have told the finance controller that the accounting treatment outlined above are correct. Any further time the finance controller spends reviewing this transaction will be looked on unfavorably when deciding our bonus for the year. So let's talk about sale and leaseback first of all. Leaseback transactions are accounted for under IFRS 16, right? Leases. If the transfer of assets to represent sale, then the seller lessee measures the right of use assets portion of the previous carrying amount that reflects to the rights retained, right? So what we normally do is lease liability divided by fair value of sale, right? Into the carrying amount, right? This means that the seller or lessee recognizes a profit or loss only on the rights transferred, okay? Not on the rights that we have right now. So if the transfer does not qualify as a sale, then seller lessee continues to recognize the underlying asset and will treat the amount received as loan, right? It would seem that the transfer does represent a sale because Cherry is only leasing the assets back for a fraction of its remaining useful life, and so the buyer lessor seems to have gained control of the underlying asset, right? So it's not for major part of the time period, right? So how much should be the carrying the right of use assets? Cherry must initially record the right of use assets at so what was the lease liability? Present value of the lease liability was 1.8, and then after that, what was the fair value? 5, right? Into carrying amount was, what was the carrying amount? And the carrying amount was this much, right? Easy. So dollar 1.8, everything is given, you don't need to calculate anything, so easy. $5 million, right? And then you multiply by the assets carrying amount. So this should basically give us 1.8 divided by 5 into 3.5.26. Right? And a corresponding amount of same amount of same amount and a corresponding how much is the thingy? 1.8 million. And corresponding lease liability $1.8 million. Right. Cherry has recorded on disposal of dollar. How much did they record profit? 1.5 million, right? So 1.5 million. This could be have been dollar how much? Let's calculate. Okay, so it should basically be 5 million dollar. 5 million minus how much was the lease liability or the rights that we have retained, right? So rights retained is dollar 1.8, right? So the this 5 minus 1.8 is our actual transferred rights, right? So divide by 5. So out of 5, right? Out of the whole assets, yep. So 5 minus 1.8, 3.2, right? So 3.2 divided by 5, 0.64. No. Profit was 1.5 million, right? So out of that as well. So that's the profit in total, right? 5 so into 1.5, 0.96. Carrying amount was this, and then that. Okay, so that's why it was a profit for the whole thing, right? But since some of the rights have been retained by us, so only the carrying amount of rights that has been transferred shall be recognized, right? So 0.96 million will be our answer. Okay, so therefore the profit on disposal should be reduced to $0.96 million by should be reduced by 0.96, right? So 0.96, 1.5 minus 0.96 0.54. So since they have already recorded a profit, so it should be corrected by this amount, right? So the correcting entry is, first thing first, right of use assets should be recognized. Right of use assets, which is basically 1.26 million, and then the profit TL will be 0.54 million, right? Credit is our lease liability for 1.8 million, right? So what will happen? Subsequently, in the next year, depreciation and interest, depreciation on the right of use assets, liability will be recorded in profit or loss, right? Current accounting treatment cannot be justified. Directors have an ethical duty. Okay, so have an ethical duty to produce financial statements which are fair representation of the entity's performance and position, and which complies with all accounting policies, with all accounting standards. The error made by Cherry understate its liabilities and overstate its assets and profits. There is clear self-interest threat arising from the bonus scheme, isn't it? If say further reviews it, it will be seen as unfavorable, right? bonus scheme. The directors change in policy regards to pensions appears to be motivated by an intention to overstate operating profit, right? Operating profit to maximize their own bonus potential. Such treatment is against the ACCA ethical principle of integrity, objectivity, and professional behavior, right? It's against all this. Alright. The objectivity of the finance controller is also being compromised. The implicit threat to reduce her bonus would seem to give rise to both self-interest and intimidation threat. Right, so it might give rise to intimidation threat. The financial controller should remind the directors their ethical responsibilities and should persuade them to change the current accounting treatment of all three transactions. If she feels she cannot discuss with the directors, and she should discuss the matters with the audit committee along with documentation of the discussion. All right. So these are the actions that could be taken, right? So once this is basically done, so this is how we basically answer it. So I think this should be enough. How much marks are we actually getting from here? Does not really specify, isn't it? 2 marks, right? For ethical implications, I think it's 6. No marking scheme has been given, so not really quite sure about that. And still, if more marks is there, so we'll just give them more information. So that's it pretty much, guys. So if you have any questions until now, please do comment down below. I'll definitely be looking forward to answering them. So yeah, I'll see you in the next question, which will be regarding AUNA 22, okay, SPR's exam kit. So see you in the next question. Bye bye.